There's a quiet machine moving your money in a way you probably don't understand, and it's making the rich richer while leaving most retail investors stuck. Money right now is silently rotating out of the sectors everyone's talking about, and it's pouring into two sectors almost no retail investor has ever looked at. And if you miss this rotation, you could spend the next 12 months watching the index crawl sideways while a small group of stocks quietly, moonshots. You catch it and you give yourself a real shot at outperforming the market without gambling on meme stocks and doing it responsibly. So, by the end of this video, you'll understand why the biggest stocks keep getting bigger, why the index is actually rigged in their favor, and the 3-step framework I use that I learned from my Wall Street mentors to follow the money between sectors and to very specific sectors money is flowing into right now. I'm going to show you the sectors, I'm going to show you the stocks, nothing held back, the exact tickers I'm watching. My name is Felix P. I'm an ex-investment banker. That's Winston back there, who's the brains behind it all. We're also the founders of the GOAT Academy, where my retired Wall Street mentors teach regular people like you and me the institutional playbook, and we've taught well over 20,000 students in the last 6 years, which is insanely fun. I'm also the co-founder of TradeVision, where we give you actual data. We're going to use that today so you see how it works. And our mission is very simple. Give regular people, you and me, access to the knowledge, the systems, the patterns that are usually locked behind banks' glass doors, right? So, let's start with the biggest picture, and I'm going to explain this in a way that actually makes sense, because macro, the big picture doesn't have to be complicated. Winston, are you here to explain the macro? You are, aren't you? Come on over here. Actually, come on over this way. All right, sit down then. Okay, you're a good boy. So he's here for an ear massage. I'm going to try and do this while massaging ears in appropriate manner. So think of the stock market and the economy like weather. You've got sunshine. Sun shines through my window. And that sort of thing. You've got clouds here. Here are the drawing skills. Bit challenge, obviously. And then you have storms and that's sort of the seasons. Seasons are changing. Now, your job as an investor isn't to predict the weather perfectly. It's impossible. It's pretty pointless. Your job is to dress for the weather you're actually seeing right now. So, what's the weather right now? What are we seeing? Well, we're worried about inflation, aren't we? We're worried that rates might not come down as quickly as they will. And well, looks like the government is going back to the printing presses. So there is a lot of stuff going on here. Geopolitics, wars, energy, oil, all that stuff. And it all seems insanely complicated. But what is important to understand all of it is that this is not 2021. In 2021, everything went up. You were a genius no matter what you picked, right? We're now in a world where what you own matters more than when you own it. Because when the macro weather changes, different sectors need different kind of clothing, right? And there are two sectors right now about to get dressed for very different kind of climate. The kind that we're looking for. And maybe this is the first time someone's explained to you macro without making your head hurt. If that's true, put head in the chat and people will be very confused by that. Interesting. But it's important to understand where you are. And all the smart people that I talk to, they all say this is no longer the buy Whittaker, by the index, and it'll just be just fine. Now, by the way, I'm not a registered financial advisor. I'm not giving you financial advice. I'm just giving you my opinion on how I see the land, and my intention is to teach you some strategies and some systems that'll make you be able to make better decisions for yourself. Yeah, does that sound fair? Doesn't sound fair? Put a fair in the comments down below. What you have to understand is that the way money moves now is different from the way money moved 5 or 10 or 20 years ago. Okay, you probably heard of the S&P 500, right? It's an index of the 500 largest US companies, and the S&P is built on something called market cap weighting. And what does that mean? It means that the bigger the company, the more of the index it is, and the more money flows in, the more the company gets bought automatically. It's a seesaw, but the seesaw is broken. Think of it this way. If Microsoft is 10 times bigger than, some smaller company, then 10 times more of your index fund money automatically buys Microsoft every single time you buy the S&P. And because so many people are buying index funds passively, your pensions do it too, your 401k does it, all those things. There's a wave of automatic demand for the biggest stocks in the world. And right now the biggest companies make up about 40% of the actual index, right? Which is the highest concentration since 1972. Last time we had an oil crisis. Coincidence, right? So literally 10 companies are 40% of the index. So 10 are 40%, and then the other 490 are the remaining 60%. And it's just because passive investing has exploded. US ETFs now have something like 13 trillion in assets. It's meant to increase to 15 trillion this year. And it's easy, it's cheap, it's convenient. But it's a flywheel that is actually quite dangerous unless you understand it. It forces billions of dollars into the same stocks, the biggest stocks, and those bigger stocks go up and up until something terrible happens, in which case they'll go down really quickly, too. But if you're just buying the index fund, you are buying mostly the top 10 companies, right? And that's just fine. The mega cap stocks are the real winners when your Microsofts and the Amazons and the Nvidias are going up. Last week was pretty good for them, as I'm recording this, but it'll be different the week you're watching this, but when they stop being the winners. And we had a few months of that. Like, look at the Nvidia charts. Don't bugger all for like 6 months. You get stuck in this system, and a lot of sophisticated investors understand this. And that's why some of them deliberately buy things like a more concentrated version. If they really want that exposure, they just want the bigger stocks where all the money is flowing. Well, why do I want the tail end, right? So, you can double down on it. It's actually not a bad idea. I do that, by the way. Not with all my money. I'm not recommending it. It might not be right for you. But there's an ETF called OEF and it actually just buys the S&P 100. And it's done quite well. But my point for you is that most retail investors don't know this has happened. So if nobody ever explained this to you, then I'm very happy you found this video. So now you're probably thinking, okay, how do I actually find the winning sectors that are about to win? And can you get to the freaking point and hurry up, Felix? And that's fine. Fair enough. And I'm going to do that. I'm going to actually walk you through the actual stocks, how we find them, and look at the charts together for those of you guys who are a bit more advanced. And I'm doing it intentionally in that order, so the beginners can get the beginner bit. And those who want push into a bit more advanced, stick around for the rest of the video. But I'm going to do one better for you. If you want to join me, as I'm recording this live the next day, literally, when I run a live training session this weekend, go to phoenixfrans.org/training and we'll do a live session where we go much deeper, for about 2 hours. Into this and that's free. So Felix, training. I love doing those. They're insanely fun, and you're going to get a lot of value out of that. Now if you miss it then, there is also a short version, a compressed version which I'll put down below in the link and I'll switch out the link for you so you can enjoy that. And that'll also be down below in the description. So, check that out. But the mistake that irritates me because I see almost everyone making it is, and I made it before I learned this playbook. You wake up, you check the news, you look at the S&P 500, you stare at the same mega cap stocks everyone else is staring at, and you think, okay, what's moving today? And looking at the same stocks everyone else is looking at, but the big money, the institutional money, but they're just better trained. They're just etiquettes, the educated money. I think that's actually the way to look at it. The educated money isn't sitting in the same stocks for it, is always rotating. It is moving from the mega caps to beaten down sectors, from tech to energy, from popular trades to unloved sectors, from expensive to cheap, from crowded to uncrowded, and so on. And your job is not to predict which mega cap will win. I believe our job is to follow the money, the actual flow of money, to see where it's moving before everyone else sees it. Mainstream media tells you far too late. Now, the good news is once you understand the framework, it is actually really not that hard. So, let me give you a brief overview of the framework. And again, if you want to learn a little more detail, click on the link down below in the description. We map out the where. Are we the weather report right? That's the first step of the 3 steps where you have to have a basic understanding of where is the world. Right now energy is scarce, minerals are scarce, defense spending, inflation, that kind of thing, just on a broad level, not deeply, just on a broad level. And then, second, we want to look at the sectors and say, hey, which are filling up with money, which ones have the strongest money tailwinds, and you rank them. You don't pick blindly. You rank based on where the money is actually flowing. And then we pick the leaders inside the winning sectors. So you might have noticed we don't look at stocks in step 1. We don't look at stocks in step 2. We only look at stocks in step 3. And I'm not making this up. This is what I learned from my Wall Street mentors. And this framework, by the way, it's evergreen. It works in bull markets. It works in sideways markets. It works in bear markets. It works in Trump markets. It works in all markets. So, let me give you one sector that I like. It's actually, and one sector that we've been in for a little while, but the money is flowing into, and it's looking pretty sweet right now. And the way I want you to look at this is picks and shovels. During a gold rush, the people who get rich are not always the miners. It can be the people selling the picks and the shovels, the equipment, the infrastructure, right? And in oil and gas, there's something very similar. You've got the producers, the companies drilling for oil and gas, and then you've got the machinery companies, the ones that are selling the drilling equipment, the compressors, the complex tools that make, the possible to get all out of the ground, and the companies that maintain it, the companies that build the pipelines, the companies, you get the idea. And I see money rotating into this pretty hard. Now, you might be wondering why. Well, first, the world needs energy. AI needs more energy than anything we've ever seen. So there is more drilling. There is just more build-out. the Middle East is blowing up its infrastructure that has to be mended. And it also means that oil prices are higher, which means companies in, say, the US or in other parts of the world that are safe will spend more money to drill more. So it means machinery companies that support the oil infrastructure are in this beautiful uptrend. Same is true for liquefy. Natural gas LNG, right? It's the energy play for the next decade. Demand is going to grow to some crazy level, and you need pipelines on it, and terminals, and export infrastructure. It's all machines, it's all equipment, and their backlog is exploding. And then you got the energy security thing. There is a geopolitical thing going on if your head's been stuck in the sand, which is actually a good thing. A lot of the world's energy flows to these choke points, and when these choke points like the Strait of Hormuz goes, and stable countries around the world go, okay, we need more storage, we need more infrastructure, we might need new pipelines, again, all good for these machinery companies. So what companies am I watching myself and I tell you how I come up with these. I literally go into TradeVision, and there is a new AI feature, and there is and I'll show you how to do it. You click it on a watch list, and it'll make a popular stock watch just for you, but you can change it, and you can say, hey, give me all land gas machinery stocks, right? And it'll do that for you. I have a list here for war and inflation macro hedges, for example, and we have those, and we've got some of these oil companies, some gold companies, and so on there too. And it's a great place to start your research. Okay, so here is the first stock that I like, which is called BKR, Baker Hughes. You can then just open the stock chart. We'll look at that together in a second. But first, what do they do? Picks and shovels for oil and gas. One of the biggest oil food service companies in the world. And in their earnings, they said they think that the Gulf DSH of Moose might be closed for shipping until the end of the year, right? Which means massive just change in construction, and the world's going to go bananas because it's missing all the Middle East oil. So they're building an offshore LNG terminal in Texas, for example. Now, when I look at a stock chart like this, and we'll come back to these in a second, I'll tell you exactly what I'm looking for. But there's another one I found that the AI spit out for me earlier, and it's NPK, a similar-ish but smaller player. It provides temporary work-height infrastructure for energy and construction projects, right? Smaller company. Stocks up pretty significantly in the last year. You can see that they really are on a chair. But that doesn't mean it's still laden in my book. 80% institutional ownership, strong by consensus from analysts. Again, I'm not selling you the stock. I don't care whether you're interested. I'm definitely not telling you to buy it. You're going to come to your own conclusion on that. But I tell you what I like about it. And this is where we get a little bit more advanced. We're going to go into a lot more detail if you join me for the live session. Again, links down below. If you miss it, watch the video. Stocks move in heartbeat patterns, right? Like that. And the way I look at that is, you see this high, you see that high, you see that high, you see this high. They're pretty much all at the same level, right? Same is true actually for the lows. They're also pretty much all in the same zone. So, what am I looking for? I'm looking for stocks that go sideways like this and do very little, which it has actually done since February or so. And then I want us to break out of the recent highs. So when we exceed these highs here, and it wouldn't take a lot for that to happen. Let me put a line in there for you so you can see what I'm talking about. About 15.28. I'm not telling you to buy it at 15.10.28. Don't do that. You got to come to your own conclusions. You got to have risk management. You got to have a whole package. You can't just have a stock tip. Stock tips are actually very dangerous. But to me, we break out of this and I want to buy it at around 15.28. Now, you might be thinking, this goes against every piece of logic you've ever heard. Why would you want to overpay? Why wouldn't you buy it now at 15.10? Well, you want to really understand that and why Wall Street insists on that. Wall Street likes to overpay a little bit, and it makes a lot of sense, and it just has to do with probabilities and risk. And it's just the smarter play. So, come and join me on the live session for that. But that's what I'm looking at here. I look at the Baker Hughes chart, the one I just pulled up before, which again, literally the AI just spits out for you, right? So, you need to know nothing at all about it, about the sector, and it'll just spit out for you these companies. And you can obviously refine your prompt a little bit more than I just have. And what do you see here? Well, you see highs here, right? And here, and here. And then there were some over here. But where do we close on that? So the close was actually about there, right? And then it went down. So all we wanted is to exceed that little previous high. We just did that on Friday. And institutions are loading up the boat because I can see it in the volume again. I'll break that down for you on Friday. So I'm liking it. I'm liking it. That's all I can say. And have we done this before? Well, go back on the chart. We had sideways action here, right? And then we break out of it there. Was that a good play? Yeah. We actually flagged out with that line in there. That was one of our early in the year plays. And again, I'm not always right. I'm not telling you to buy things. You get the idea. Or even you go back to the bottom of the market here. You had that zigzaggy thing there. You broke out of it here. Volume explodes and boom, right? Bada boom, bada bing. That kind of thing. So, we like it. Now, if you have never heard of this sector, if you've never ever looked at all service machinery stocks, let me know in the comments. I'll just new in the comments because it's new to you and it'll be helpful. And also let me know whether that's helpful. Put another helpful in there as well. Now, the second stock, and this is a little bit easier to understand perhaps, is called mining and quarrying of non-metallic minerals and other metals. I know. Exciting, right? And it also seems a little bit random until I explain. Well, the world is about to need way more of the stuff than we ever heard of, right? So again, we can go into our little AI lab, so you don't know anything about it, and just say, I'm just going to edit the one up here and just say give me critical mineral stocks. Okay. There we go. Greater than. It's come on. Good boy. What have you got under your greater than, right? And now you've got a bunch of companies that are in that space. By the way, in a browser, you can literally zoom out on this and literally zoom out on the browser, and it sort of becomes your workspace. I think, for investing, all your ideas, all the news that you want on the spaces you want, you can adjust it to the news that you want. You know, I like looking at the S&P day chart, for example, and you could change it to whatever it is that you're looking at, and it's just kind of a workspace that you can build. You can arrange with all the stuff that you want with all the charts of all your stocks and so on, and I think it's just super useful. And I should mention there is a pre-sale to get access to this AI feature. Once it's properly released, it's still in beta mode. It'll cost you more and there's a free trial to that. So check it out if you go down below. There's a link. I think it's felix.org/TradeVision AI.